September 15th, 2008. Lehman Brothers falls, 9 million jobs vanish, and $30 trillion in wealth are erased. Now, in 2025, AI spending isn't just big. It is more than half of US economic growth. And Michael Burry, the man who called the last collapse, is betting on another. If history is echoing, do you know where the sound leads this time? Lehman Brothers collapsed in a single morning, but the fallout lasted for years. 9 million Americans lost their jobs. $30 trillion in global wealth vanished. Families lost homes, retirements evaporated, and the shock rippled through every corner of the economy. The world learned the hard way what happens when warning signs are ignored, and faith in a system outweighs the facts staring everyone in the face. 17 years later, Michael Burry is watching the numbers again. In mid-2025, his hedge fund, Cyan Asset Management, filed with the SEC, reporting over $1 billion in put options against Nvidia and Palantir, the two companies at the heart of the AI boom. His short positions include 1.15 million Nvidia contracts and 5.75 million Palantir contracts, and they make up 80% of his fund. The scale is staggering. But so was the conviction behind his bet against housing in 2005, when everyone else was still dancing. Burry's letters do not read like a gambler's hunch. They read like a warning. He points to the same patterns: exponential leverage, borrowed optimism, and a market built on circular promises. In 2008, he saw how risk was hidden in plain sight, masked by complex trades and relentless cheerleading. Today, he sees AI companies spending on each other's products, inflating revenue that may never be matched by real demand. He is not betting against technology, he is betting against the math. And the last time he did that, the world paid attention too late. The devastation of 2008 was not just numbers on a screen. It was lives upended by a crisis no one wanted to believe could happen. Burry's bet is a reminder: when the music stops, someone always gets left holding the bill. In the first half of 2025, a single force powered more than half of America's economic growth: artificial intelligence. The numbers are staggering, almost surreal. Microsoft is pouring tens of billions of dollars into new artificial intelligence infrastructure, with annual spending estimates for cloud and artificial intelligence projects climbing past $20 billion and rising sharply each quarter. Amazon Web Services is not far behind, channeling nearly as much into building out its artificial intelligence capacity, stacking data centers across the globe in anticipation of future demand. Google's capital expenditures for artificial intelligence and cloud infrastructure now top $12 billion a year, with analysts projecting even larger outlays ahead. Meta, once known for social media, has committed over $10 billion this year alone to artificial intelligence research and the hardware to support it. Then there is Nvidia. Once a niche chip maker, now it commands a market value above $3 trillion, more than any automaker, oil giant, or industrial titan in history. Its artificial intelligence chip revenue crossed $100 billion in 2025, with every major tech firm scrambling to secure its latest processors. OpenAI, the startup at the center of the current artificial intelligence frenzy, has reached a valuation of $157 billion, despite annual losses approaching $12 billion. Across the sector, more than 1,300 artificial intelligence startups now claim valuations above $100 million, and nearly 500 are valued at over $1 billion each, most with little or no profit. The scale of investment has no modern parallel outside of wartime. These are not measured bets on proven demand. They are massive wagers that tomorrow's breakthroughs will justify today's spending. The money is not trickling in, it is flooding, reshaping the balance sheets of the world's largest companies and redefining what counts as economic growth. Nvidia stands at the center of a financial web that looks less like a healthy market and more like a closed loop. deals with OpenAI. That money does not sit idle. OpenAI turns around and spends billions on Nvidia's own chips, fueling the company's record-breaking hardware sales. The cycle does not end there. OpenAI signs a $300 billion contract with Oracle for cloud infrastructure, a sum that dwarfs its actual revenue. Oracle, in turn, finances these massive data center builds by taking on debt. Its debt-to-equity ratio has now reached 500%, a figure that would have raised alarms in any previous era. Microsoft, with its deep stake in OpenAI, becomes both a beneficiary and a participant in this cycle. It pours billions into AI development, then purchases cloud services and hardware from the very companies it is invested in. Microsoft alone now accounts for 20% of Nvidia's revenue. Meanwhile, Nvidia holds equity in CoreWeave, a rising cloud provider that supplies GPU power to Microsoft and OpenAI. Each transaction boosts reported revenue and valuation for every company in the chain, creating the appearance of explosive, independent growth. The demand is not coming from outside customers. It is coming from within the loop, each company's spending propping up the next. This structure makes it nearly impossible to tell where genuine demand ends and artificial demand begins. The numbers look impressive on earnings reports, but the underlying cash flows are recycling through the same handful of players. The foundation of this boom is not broad-based customer adoption, but a circle of bets, each one dependent on the others holding up their end. If one falters, the illusion of unstoppable growth could collapse just as quickly as it was built. Deutsche Bank is now sitting on $35 billion in synthetic risk transfers tied to AI loans. These synthetic risk transfers, bundles of credit risk separated from the actual loans, move exposure off one balance sheet and onto another, just like collateralized debt obligations did in 2008. The structure is familiar, risk is sliced, packaged, and sold, while the original lender keeps collecting fees. The math is supposed to make everything safer, but it really just hides where the risk ends up. Oracle's credit default swap spreads have jumped from 80 to over 210 basis points since January. That is a level not seen since the last financial crisis. The market is pricing in real doubt about Oracle's ability to repay its debts, with a debt-to-equity ratio now at 500%. Oracle's AI data center expansion is funded almost entirely by borrowed money, and the cost to insure against a default is climbing fast. Credit default swap traders are flashing the same warning lights that blinked before banks toppled in 2008. OpenAI's commitments are even more stark. The company is locked into a $300 billion contract with Oracle over 5 years, $60 billion a year. Yet reported revenue for 2025 is just $13 billion. OpenAI lost $12 billion this year alone, burning cash at a rate that no amount of optimism can paper over. The gap between what is promised and what is earned is a chasm. The only way it closes is with fresh money, new investors, more debt, or both. The numbers do not lie. Synthetic risk transfers, surging credit default swap spreads, and a cash flow mismatch of this size are not complicated. They are a countdown. When the math stops working, it does not matter how good the story sounds. The risk is already baked in. Webvan once promised to reinvent grocery delivery. Flush with nearly $800 million, the company built automated warehouses in dozens of cities, betting that demand would catch up with their ambition. The warehouses stood ready, stocked and waiting for orders that never came. Within 18 months, Webvan was bankrupt, its infrastructure left empty, a monument to the dangers of building for a future that arrives too late. Today, the scale is even larger. AI-related capital expenditures are now 17 times greater than at the peak of the dot-com bubble, and 4 times larger than the housing boom that toppled the global economy. More than 1,300 AI startups have valuations above $100 million. Hundreds are valued at over $1 billion, most without profits. The lesson is simple. Being right about the technology means nothing if the timing and the math do not work. Overbuilding on hope can erase fortunes faster than any new invention can create them. Nearly 500 AI startups now carry valuations above $1 billion. Most are still waiting for their first real profits. Over 1,300 more have crossed the $100 million mark, all riding on the same wave of belief. But the real risk is not just in the startups. The 10 largest companies now make up 39% of the entire S&P 500, an all-time high. 75% of the market's returns since ChatGPT launched come from AI stocks. That means retirement accounts, index funds, and pension plans everywhere are tied to the fate of just a handful of tech giants. When so much of the financial world depends on one sector, the line between innovation and exposure blurs. The entire market is leaning on the same wall, and if it cracks, there is nowhere left to hide. Right now, more than half of America's economic growth rides on AI, bets that outpace real demand and revenue. When trillions hinge on speculation, risk is not just financial, it is systemic. The warning signs are clear. In markets built on promises, reality always arrives. The question is, are we listening?